The Rebel Capitalist Show.
I want to kind of transition into kind of investment ideas around this kind of thesis of bigger government and a more maybe globally, I don't want to say a one world kind of global government, but the Davos types trying to push this agenda through the politicians and the mainstream media, which they influence to a heavy degree. So if you're an investor, you say, okay, I don't like it in my personal life. I'm going to push back against the authoritarians as much as I can. But for my portfolio, I want to set it up in a way that's going to benefit from them pursuing these insane policies or trying to push this crazy authoritarian narrative. But I think you're just as bullish long-term on commodities as I am. I've been saying that I think we're probably in one of these 10 to 15 year super cycles like we saw from 96 to 2011. So, and I know most of the people understand the supply and the supply demand dynamics that are in play right now, but they haven't thought through how the supply side or maybe the demand side could be impacted by these global elites trying to push this agenda. And I know you've given that a lot of thought. So could you share some of the kind of your analysis on these deep dives that you've done?
Well, what we've got to remember, George, is that we're coming into this now, as we are, this situation with an absolutely egregious lack of capital spending in the commodity and in particular the energy space.
And why is that, Chris? Because I think this goes back to the Davos types, right, in their narrative.
There are a couple of elements that come into it. We can begin with the easiest one, which is purely cyclical. So if we go back to sort of previous boom, it was 2010-ish. We always have this happen in commodity space. It's an extraordinarily cyclical market. It is very capital intensive.
But has it been exacerbated by ESG and the climate change movement?
So, yeah, but if we go back, so you had this ordinary, typical bear market that came about as a consequence of oversupply. So that was all kind of understandable. But way back 2-3 years ago, we should have seen CapEx spending picking up in a normal kind of environment.
Cycle.
That never took place. And it never took place because of what you alluded to, which is this political narrative, right? It's the ESG, save the world, the climate Nazis, there's been a whole host of political narratives that have made it extraordinarily difficult to bring about additional supply. And that's not gone away, and now it's accelerating. So they're telling us that the solution to this is going to be renewables. So from an investment standpoint, the way that we look at things, because like the most robust portfolio that you can have is one that has natural hedges within it, right? So that because we don't all know what's going to happen. There can be all sorts of events that take place either at a company specific level, at an international level. So a certain country could come up with a profits tax, for example. Okay, that can impact that particular sector. So you want to have, as best as you can, a robust hedged portfolio, which you will make changes as new information flows come forward. But so if we look at what they're telling us, aside from the fundamentals, and the fundamentals are that we need to have fossil fuels if we're to continue even just half of the things that we want and need in the world. That's just a reality. They're telling us that we're going to use renewables. And if we look at the renewable side of things, I watched a presentation from, I think it's the energy minister in Australia, who was putting forward this idea that, and they were heralding this particular project in South Australia, which is a huge battery operation. Now, this thing it can power 6,500 houses in a day. there are in South Australia something like 760,000 houses. So that's 0.85% of the homes in South Australia. That this is not 1%, right? 0.85%.
Right.
But South Australia has uses about 300 gigawatts per hour of electricity per day. And homes only account for 30% of that. So the 0.85% is actually way worse. And it worked out that if you were to power South Australia with this quote unquote renewable energy, you would need 230 Hornsdale batteries. Now you go, what goes into a battery? So when you go and you look at what goes into these batteries, you realize that we need to be mining the shit out of the planet to get the lithium, the cobalt, the copper.
Right.
Okay. And then when we look at that supply side, we realize that we're massively underinvested there, because again, in this woke Western narrative, you can't get a copper mine up and going. You cannot get a lithium mine going. You cannot get cobalt, even if you had the cobalt in your country, and not all countries do. So we have an extraordinary situation whereby you can hedge your portfolio for both outcomes. And the outcome that we will have is a massive energy crisis, which we're only just beginning now to step into. So we're either going to utilize renewables, and we're going to go down that path, and there'll be trillions of dollars or billions of dollars spent on it. It won't solve the problem, because it cannot solve the problem. We've never, ever gone from a more energy dense medium to a less energy dense medium in the world.
Right.
And they're telling us that we can and we will and we should. That's going to have catastrophic consequences, not just in energy, but across all the way through the supply chain in terms of agriculture, you name it. So again, when you come to portfolio construction, we have insufficient supply in not just fossil fuel side of things, but also in the quote unquote renewable space. And so that's the situation that we're in today, George. And it makes investing extraordinarily difficult, but it also makes it more asymmetric. Going back and looking at previous recessions and or depressions, which and then saying, okay, what happened in those timeframes with respect to a portfolio that is similar to that which we have? And so when I say similar, I basically took a very broad 25% breakdown and said, okay, 25% in precious metals, 25% in ag, 25% in base commodities, and 25% in energy in energy. Okay. Mm-hmm. So there's your kind of commodity portfolio, if you will. And then we looked at like 1929, the late 1960s through 70s, and then the late 90s. And then I would suggest now sort of the 2020s is the next one. Right. But if we looked at those three, now they were not like the 1930s was a deflationary one. The 1970s was inflationary, right? But if you took that portfolio in 1929, by 1940, it would have been up, I think it was about 120%. Don't quote me on that. It was 120 something percent. Okay. And so remember, that was the Great Depression. And so
if that's
the broad
nominal,
stock market
then real would have been higher.
Yeah, I mean, the broad stock market was down by 50%. So it halved roughly over a decade. Holding cash would have given you over that period of time about 20%. Okay. So obviously better than losing 50% in the stock market. But owning a commodity portfolio, you literally look like a genius. And you go, well, there's demand destruction there. 100% there was. But when you have demand destruction, like when people stop working, they stop producing.
Yeah. So the bottom line is you have demand destruction, but you have an increased rate of supply destruction.
Yeah. And then you take the 70s, right? So the 70s was quite a different crisis, right? That was an inflationary crisis. And a similar portfolio over that decade would have returned you about 400%, better than the deflationary one from 1929. But remember, there you were
Is that nominal though,
121%.
Chris?
Yes.
Yeah.
Yeah.
But still, in adjusted real terms, you're still making a lot of money there.
Well, real rate of inflation from 70 through 80 was about 80%.
Okay.
Yeah. So you were still way ahead. I mean, like way ahead. And so today we've kind of got.
And what did commodity? I mean, I know this, but just for the viewers, what did the commodities do during the .com bust or recession, the slight one we had, and what did they do during the GFC, and then shortly thereafter?
In the .com bust, and you know, because that was one that I traded, right?
Yeah.
So well, that was what 2000 through. Now, if that portfolio, roughly 25% across all of those, trying to think of the numbers now, it was a 360% for the decade.
Starting through 2010.
So if you took 1999, 2000 through to 2010.
Right.
Yeah. And at the same time, I mean, broad equities were up, I think, about 30-40% over that time frame, which was poor in terms of purchasing power over the decade. But again, you way outperformed.
I think what's interesting too, those two
like a
recessions.
Bonds, but you think about your risk parity trade, which most people are in. It's kind of, it's in the 60. You've got, I don't know, maybe depending upon age, 20-30% in growth, and like, that's unfortunately where most people are in. And then the 40%, well, that just looks like a bug in search of a windshield, because these crises periods that we've just been discussing are not the multi-generational, like once in 100-odd year event, which I believe we're in.
Yeah.
But even if we were not, even if we were in a more traditional one, like 29, like 70s, like 2000 through 2010, it seems evident to me that that's the safest portfolio that one can have.
Yeah, and I think if my memory serves me right, recession of 2000, 2001, commodities dropped a bit, then screamed higher. Then you get the GFC, commodities drop a bit, scream higher to when they peaked out, and I think it's like 2011, something like that. Then you go into a bear market, the downside of the super cycle, until, call it 2020, when oil was at -38. I think that's kind of how it'll play back when we look at this in 20 years or so.